One. Hello and good afternoon to everyone that's currently tuned in live with us on another episode of Phillip Trading Podcast. I'm your host for today and my name is Trent. With me here today is my colleague William, a senior dealer and marketing executive from Phillip Futures. How are you today, William?
Very good. Thank you, Trent. Nice to see you again.
Yeah, same. Okay, for today's podcast, we'll be discussing on the topic, can the recent gold rally persist? So to our audiences out there who are currently trading gold futures or interested to trade gold futures, do not miss out this podcast. Once again, I would like the help of all our beloved audience today to share this video to all your friends. The more people that are watching this video, the more we are motivated to deliver greater content to all of you. Okay, so without further ado, let me give you a background of today's topic. Can the recent gold rally persist? So recently, gold price touched its bottom at the end of March 2021 to embark on a 2 months long rally. So we'll be sharing on what are the fundamentals of gold, with gold price trading above 1,900. And could this be the final rally for gold? Now let me pass on to William to give a more thorough analysis of the gold market.
Okay, thank you, Trent, on the introductory. Okay, like what Trent said that gold is having on a rally is embarking on a 2 months long rally. This is a very, I would say, quite a long rally for gold, to be honest, considering the fact that the market is currently unstable and stable at the same time. Okay, there is not much super bad news, but the gold is still on a rally. Okay, so can this rally continue to break new high? I think this is the main topic that I'm trying to share today. So before I move on, just a very quick disclaimer that whatever I share today is not a buy and sell call. Okay, so yeah, everything, if you want to know more about it, you can consult us on it personally. Okay, first question here. What is the key thing to determine the price of gold? Let us understand this a little bit before I move on to the main topic, which is, can gold continue to go up? Okay, usually for gold price, when we want to look at the gold price, usually we will look at the main thing here is the real interest rate. Okay, so what is real interest rate? I will try to explain it a little bit further later on, but basically the key formula here for gold price to monitor the fundamental of gold price is to monitor the 10 years treasury bond yield. Usually you minus the inflation, you will get the real interest rate, which is the yield of a bond that is protected by the inflation, meaning to say that when the market is in inflation period, people tend to buy these treasury inflation protected securities. It's a type of bond where it's hedged against the inflation. So people will only buy it when the market is having an inflation. Okay, so in short, if you look at this formula, when the inflation is very high, okay, inflation is very high, is higher than the bond yield, you will get a negative yield of this inflation. So what does it mean of a negative yield of this inflation? We will look further. Okay, next. So just now I shared about the real interest rate, okay, which is this one. Now, what is this real interest rate? So basically, real interest rate refer to the treasury inflation protected securities, which means this bond is hedged against the inflation. So when you buy this bond and there is inflation, usually the US government will calculate how much is the inflation being incurred, and then will pay you extra coupon, which is extra interest rate, which is why during the inflation moment, okay, issued by the US government to protect investors from a decline in purchasing power. So during inflation period, investors will tend to buy this bond, okay? When they buy more of this bond, what do you see? The yield will definitely drop, okay? The more the people is buying it, the lower the yield, okay? Which means the price of the bond is going up and the yield, the return is dropping, okay? If you understand this concept, yeah? Okay? So when we see this kind of yield, meaning to say that a lot of investors is buying this bond from year 2019 until the mid of 2020. And then people stop buying it and start disposing it in 2021. So what does it mean when people is disposing the inflation hedge bond? What does it mean? Okay, It actually tells you a very, very important information here. When people are disposing inflation hedge bond, it means that the market in general, the hedge fund in general, the fund manager in general, they are expecting the market to recover from inflation, which is why they are disposing the inflation hedge bond. Now, you might ask me the next question: who is going to buy bond with negative yield? Okay, who is going to buy bond with negative yield? So if you understand how inflation hedge bond works, you should know that investors usually they will still buy into inflation hedge bond regardless of the negative yield, is because when there is inflation, remember the formula. When this inflation is very high, the interest rate will actually go up. Okay, this rate will slowly go up when inflation is very high. Okay, when inflation is very high. So if you understand this concept, then we will move on to the next one, which is the nominal interest rate, which is this one, the 10 years bond yield. So basically, this is the very common one. I think everyone should be familiar with it, because this is the thing that the news has been published all over the internet. Okay, they are all talking about the 10 years treasury bond yield, which is keep going up, which caused the stock market to drop. Okay, this is the second thing. So basically, this thing minus this inflation expectation equals to the thing that we mentioned earlier, okay, which is the 10 years inflation hedge bond yield, the yield, okay? So inflation expectation is something that the Federal Reserve monitors super closely. If you look at all the FOMC meeting, they keep saying that as long as inflation stays above the 2-level mark, which is this level, they will try to increase the interest rate. Okay, so if you look at the inflation expectation, this is exactly the inflation expectation that the market is monitoring. If you look at it, currently the inflation expectation has reached a 2.4 mark, and the maximum in 2008 or 2010 is just somewhere 2.6. Okay, which means that the level that for inflation to go up is actually quite limited. Okay, it's actually quite limited. Now, after we understand the three things that will affect the gold price, which is the inflation expectation, which is the treasury bond yield, and also the inflation bond yield, okay, then we will move on to the next one. What causes gold price to actually go up from June 2019 to June 2020, okay? Gold actually break out from June here. If you look at the date here, this is the day, it's the mid of 2019 onto a 1 year long rally. What really causes it? And does the reason for it to rally still exist? If we can understand this part, we should be able to understand if the gold can continue to break new high. Okay, now, what causes the gold price to rally back in June 2019 to June 2020? If you look at it, it's all down to, remember I mentioned that it's all down to the inflation bond, the inflation bond yield hedge, okay? The bond yield of the inflation hedge. So basically, if you look at this chart here, this is the mid of 2019. This is where the market actually expect inflation to really comes in, which is why you see the bond yield actually break below 0%, which means investors is buying it aggressively, regardless that they need to pay interest to the US government just to hold this bond, okay, because they are expecting a huge inflation coming up since mid of 2019. So this is, if you look at the timeline, the two arrow here is the timeline that gold price actually shoot up and reach a peak. So if you look at it, the inflation bond yield, just now if you remember, the yield started its downtrend to reach a 0 and drop further into negative territory in 2020. So market is expecting this and also caused the rally. Now, if you look at it, the drop in yield, like I explained earlier, the drop in yield means that investors are buying more of the inflation hedge bond, okay, indicate that the market is expecting inflation to hit badly. Hence, they are willing to buy, even though the coupon rate is 0. But reach here, the market actually expect the inflation to reach a bottom already. That's why you see it enter into a consolidation here. So what are the factors that affect the gold price? Okay, let's decode the three formulas that I shared earlier, which is real interest rate equals to the nominal interest rate minus the inflation. So what is real interest rate? This is the inflation hedge bond yield. Okay, this is the inflation hedge bond yield, and nominal interest rate is the 10 years treasury bond yield. And the last one is inflation expectation, which is what the market is expecting. Now, if you look at these three formula, okay, these three things, these are the two factors, because if the bond yield of the inflation hedge go up, meaning to say gold price should go down. Because more people are disposing the bond already, meaning market is not expecting inflation anymore. But if this real interest rate, which is going down, meaning that the market is buying more of the inflation hedge bond, which means that the market actually expect to enter a further inflation. Okay, so this is the thing that caused gold price to go up and to go down. Now, which is also why it's very common that people always say that gold price is associated to inflation. Why? Because inflation expectation is part of the formula here. So let's look at the two items, the two factors that will affect the gold price. The first one is the 10 years bond yield, okay, which is the nominal interest rate. You look at here, is US government treasury bond yield, okay? Now, we can have two assumptions here. We can have two assumptions. The first one is that if the percentage of increase, if the percentage of increase in this bond is greater, the percentage of increase in this yield is greater than this one, okay, gold price will crash, okay, gold price will crash. Now, vice versa, if the percentage of increase in the inflation expectation is greater, is higher than the increase of the nominal interest rate is bullish for the gold. Why? Because when this increase greater than this one, then this formula, because this more than this, then this definitely will drop. Okay, will drop and hence cause gold price to go up. Okay. So now, if you remember what I shared earlier, the inflation expectation has almost reached a peak. So to me, inflation is about to end, because if you look at the chart, the 10 years inflation expectation is at 2.4%. Okay, and it's almost hit its expectation, the maximum at 2.6. So the room for inflation to continue to go up, actually, the chances, if you ask me, is quite slim, or it's quite near to the peak already. So if you look at this one, just now I mentioned that as long as this one doesn't have room to go up, because doesn't have room to go up, then definitely gold price is bearish, because as long as this grow more than this, that is bearish for the gold. Okay, now go back to the most important thing, which is the real interest rate here. This is the real interest rate, which is the bond yield of the inflation hedge bond. Okay, now if you look at it, this bond, if you look at the yield, is trying to build a bottom for almost 1 year since the mid of 2020. This is also why the gold price entered into a long downtrend or a long consolidation moment, okay, since mid of 2020, if you look at it. So the only way for gold price to shoot up is for this yield to continue to go down, because the only way for it to go down is that the market perceives that the inflation is going to continue and continue to flood into buying this bond. Okay, then the gold price might go up, because market expect the inflation to continue. So now, if you ask me, is inflation peak or near to peak? There are a few things that I have been monitoring quite closely to come up with a conclusion this myself. So the first one is that the price of commodities has actually gone up by almost 100%. Most of the commodities, if not all, okay? The second one is that the March and April FOMC meeting discussion were mainly on reducing bond purchasing or to increase interest rate. And on top of that, if you look at unemployment, rate, actually it's the first time in May, the announced by the US, it's the first time that US actually announced a positive growth on unemployment rate, okay, a positive growth. for the first time after a year since the economy hit by the COVID. And if you look at unemployment claims, we are talking about claims, it has been dropping continuously for 5 weeks in a row and also hit a lowest claim level since April 2020. So the employment segment in the US actually has turned better. Okay, all these are bullish for the market. It's a bull market. It's good for the market. And you do know that when employment is increasing, US might reduce its QE or might reduce the money they give out to the citizen, okay, and might even increase the interest rate, okay, because employment, how the inflation go are all the key factors that will be looked by the Fed to determine whether they want to reduce bond purchasing, they want to reduce QE or increase the interest rate. Now, the third thing that we monitor is that inflation expectation, like I mentioned earlier, has been steadily above 2% since January 2021 and is currently at 2.4%, which is just 0.2% away from 2008 high. Okay, and the last thing that I monitor is that US dollar. Usually, if you look at the news, they will always tell you that when US dollar rises, gold price drop. Okay. Now, if you look at US dollar position at the moment, it's about at the low of 2018. And this level, if you talk about technically, is going to be strong. It's not going to be easy to break below. Even if it break below, right? I think it's when US dollar lost its value, right? Actually, it's bad for US economy because people might think the demand on US dollar might not be as strong anymore because why do we say that US dollar is is like a greenback, like gold, something like that, like a inflation hedge? Is because of how US dollar can hold its position, can hold its value like gold, which is why US dollar has always been a strong currency in the world. Okay, so if this level break below 2018, if you ask me, I think it's very easy for US government to protect the level. The easiest way is to increase the interest rate, because when US government increase the interest rate, the hot money in the world will easily buy into US dollar and then eventually flop back to US. When they buy into US dollar, it's very easy for US dollar to go up. So like I mentioned earlier, a strong US dollar is bearish for gold. Now, compared to the last questions here that I want to share is that, will the investors still buy the inflation bond, hedge bond, if inflation is peak or near to peak? Okay, so what will happen to gold if the inflation hedge bond yield move back to zero? So when it moves back to zero, meaning to say the market generally do not think that there's inflation anymore. Okay, it might be deflation. Okay, so in that case, if you just purely look at this chart here, you know that gold price go into rally because the yield starts to turn into negative since mid of 2019. Okay, and it has started to build a bottom. And if you look at it, actually people has been slowly disposing this bond. Okay, which is why you see the bond yield starts to go up and then try to build a bottom. So unless you believe that the yield will still break new low, or else, if you ask me, it's pretty hard for gold price to break new low, provided this bond yield, which means people flood into buying this inflation bond yield, inflation hedge bond. Okay, so just closely monitor how the inflation hedge bond yield plays out, then we will probably get an idea on whether gold price can continue to rally or this could be the last rally for gold. All right. Okay. With that, I think that is all for the sharing.
Okay. Thank you, William, for the wonderful sharing. And I hope our audience is able to learn something new about the gold market today. And to all our audience who are interested to trade COMEX Gold Futures, you can now open a trading account with Phillip Futures entirely online at the comfort of your own home. No more hassle of submitting or courier the physical forms. For more details, you can actually drop us a message on Facebook, and our representative will get back to you. Alternatively, you can also visit our website, and under the Open Account tab, you can find more info on the online account opening. Okay, lastly, before we end, if you have any question or any topics you want us to discuss next week, you can message in the comment box below. Thank you for listening to our podcast and happy trading for the week. Thank you for your time too, William.
Okay, thank you. Thank you, Trent.
Okay, bye-bye.